Hello and welcome. This is another video on finance by me, Fireball, and
Hello, this is Isthatrathi.
we're going to cover what is the best investment options based on our research post COVID-19 crisis. Currently, based on studies, we can say that 90% of returns that anyone earns from any asset depends on the asset class that they have chosen. Asset classes are debt, which includes fixed income such as fixed deposits, then there's recurring deposits, then there's equity, which is another asset class, then gold, oil, which falls under commodities, currencies, and we have uh, real estate, which would be an alternate investment classes. So your return depends on which class you have used, and most funds you would see, most investors would diversify. During a crisis situation, the returns from all these asset classes fall, which also means that correlations spike during crisis.
Coming to the financials, there is still some uncertainty in the market, which we think will be gone and normalcy will resume by the end of April and start of May due to the two following reasons. Number one, the number of people dying each day is falling in Italy. And second, China has started its production back in the mainland China and Wuhan area. Now, coming to the problem of trust, the January to March period has been an exception because when we look at the past 110 years of data, the stock market has been bullish in the 94 years. Hence, we expect the long-term trends to continue. And as for why we chose mutual funds, they give us diversified equity exposure, and we expect equity to give us faster returns.
We have covered aspects such as expense ratio of these funds, fund sizes. We've looked at their standard deviation, which is their volatility, the returns, how consistent they have been. Lower standard deviation is better. Then we've looked at their beta performance compared with other funds. Again, lower is better because lower beta means more predictability. What we expect is what we would get in the future to some extent. Then we've looked at Sharpe ratio, which tells us every return that the fund earns for any additional percentage of risk taken. We've also looked at alpha, which is how the fund has beaten their benchmark. We've looked at past returns as well. For example, for passive funds, we've looked at 1 month, 3 month, and year to date.
And as for active funds, we have looked at 1 month, 6 months, 2 year, and 5 year returns with main focus on 5 years.
The scope of this discussion is to look at active managed fund, at passive funds, and some exotic options as well.
As to what we did for the research, we did some online and statistical research, and based on those results, we chose the funds for active and passive fund category.
What is active fund? An active fund is a fund where the fund manager has discretion or decides the stocks which he would invest in from their own research and using his own or her own judgment. In passive funds, the fund manager has a mandate. Let's say, for example, Nifty 50. So he will use all the money that has been invested in that mutual fund to buy shares of Nifty 50 in the ratio in which the stocks form part of the index. That's the passive funds.
All right, coming to the types of active funds, we have two types of active funds. Number one, the discretionary fund. These funds rely on the judgment of manager and team, and hence they are also quite subjective. The focus is on return, and the research is done by using top-down, bottom-up, or hybrid approach. The second type of active fund is quantitative active funds. These are rule-based funds, and the main focus is on factor returns. Most of these funds are backward-looking rather than forward-looking. Coming to the investment thesis for active funds, the manager believes that the markets are not efficient. Hence, one can outperform the market by picking undervalued stocks or by picking a stock that will give more return than the market has priced it in. The pros for active funds is that they provide better return than the market. And as for the worries, it is hard to find a fund that can consistently beat the market. Also, the money can be lost because it depends on the manager and team's decisions in the stock market. So there is always a risk for that. We can see that we have given equal weights to all the four categories: standard deviation, assets under management, past returns, and expense ratio. We have the funds, the top four funds we found for active funds, namely Axis Focus 25, IIFL Focused Equity Fund, SBI Focused Equity Fund, Aditya Birla Sun Life Focused Equity Funds with their benchmarks on the right side. We will compare the funds based on the Sharpe ratio, expense ratio, assets under management, and standard deviation. As for the Sharpe ratio, the higher it is, the better. And the winner for this is SBI, but Axis is just 4 basis points behind it. Coming to the expense ratio, the lower it is, the better. And Axis is the clear winner here, with the next best option, that is SBI, being 33% higher than the Axis's expense ratio. Coming to assets under management, the Axis has the highest assets under management, but both Axis and SBI have quite a large quite large assets under their management. That will help them in better absorbing the losses and better maneuver in the market. Now coming to standard deviation, it is a measure of volatility, and the lower it is, the better. The category average is the lowest here, and there is a reason for that. The reason being that there are a lot of new funds that are being created in this category, which brings down the average standard deviation for this. Looking at the returns data, we can see the impact March has made on returns of all the funds. However, since main focus is on 5-year returns and Axis has outperformed in that area, Axis was hit the most in the 1 month period because of its large beta compared to the other funds. And if we take out the impact of March, the Axis would have outperformed all the other funds. Hence, based on these quantitative factors and other qualitative factors, I recommend Axis Focus 25 to be a good active fund to invest in if you have the investment horizon for the next 3 to 4 years.
Coming to passive funds, there are two types of passive funds. One is the indexed fund. What they do is they copy or mimic an index. Now, choosing an index is important because you want an index which is transparent, investable, and has liquidity. We've chosen a larger index compared to the smaller Sensex 30 or Nifty 50. We've chosen Nifty 100 because it gives greater diversification. The other type of passive fund is a fund that focuses on smart beta or factors such as volatility, inflation, foreign currency, GDP, any factor which the mandate of that fund decides. These passive funds have a belief that the market has complete knowledge and is correctly priced. This is also known as the efficient market hypothesis. What this means is they believe that the share price of every security is what it should be and it is correctly priced. With this belief, there is no room for any mispricing to be identified or any undervalued stocks. They have in the past performed better than all active funds, and again, the risk with any mutual fund is that there is the market risk. If market falls, these funds will also fall. And since they have a target, a rule-based system, for example, if Sensex decides to remove one of the constituents and add another one, then a lot of the large traders would sell that stock which is to be removed and buy a stock which is to be added. What this means for the fund is that the fund would sell the stock at a lower price and buy the new stock at a higher price, thereby reducing your returns. I'm not giving any trading strategies right here though. What we did is we focused a lot on expense ratio, which is why we gave it a 60% weightage. We looked at past returns. What matters is how close the funds perform to their benchmark. The tracking error usually would be minimal. That's what we were looking for among all the mutual funds. Then we looked at standard deviation and asset under management as well. We designed rankings on these weightage for all our funds. With this, we picked our top four: Axis Nifty 100 Fund, Nippon India ETF Nifty 100, LIC Mutual Fund ETF Nifty 100, and Principal Nifty 100. They all have the same benchmark, Nifty 100 Tri. Looking at their expense ratio, what we found is LIC and Axis have a very small expense ratio, 0.1 and 0.16%. significantly less than the category average of 0.45. This means that they have very little management fees, and so the returns that you earn on these funds is what the market earning is, which is why they're the top tier. And as you can see in assets under management, they both have 313 crore fund, which is again great. Standard deviation again is very low for most of the fund. However, 9.15 category average is low for the same reason it is for active funds. There are a lot of new players, a lot of new funds, and their period of activity is small, which reduces their standard deviation. For Axis Bank, we had to calculate an annualized SD because this has been launched only 6 months ago, but still it is to be seen what happens later on. Beta for all the funds have been roughly the same for these four funds. Other funds have been much lower, which is why the category average is again low. For Sharpe ratio, we couldn't calculate Axis or Nippon, but LIC has a very good Sharpe ratio of 0.3, greater than the category average. Looking at returns again, March has been a disaster for all the funds, and that is reflected in all the returns, whether it be year to date, 3 months, or 1 month. So we compared every fund with their return against the category. For example, if category made 1%, what the other funds made. And here we can see that Axis has outperformed all its peers. With this, we recommend Axis 100 Nifty Fund to be the best passive fund currently to invest for again the time horizon of 3 to 5 years. With this, we'll come to the last fund that we want to recommend, and also Motilal Oswal Nasdaq 100 ETF fund. ETF is a type of index fund where they raise the money, that money is used to buy stocks, and that money is not increased. It's not an open-ended fund, and the ETF units are then traded on the stock market, which creates a lot of liquidity. Now the cost remains low because the ETF fund manager does not have to pay out all the unit holders in case they want to sell the units, so that reduces cost. However, here the expense ratio is higher than what we saw for LIC and Axis, but that is mostly because their investment is in US, so there's US taxes along with Indian taxes. Multiple other expenses have come into the play, and the return is in USD, so that adds a forex risk, but still we believe USD being a premium currency, it will outperform INR anytime. Sharpe ratio of this fund has been the highest in our research, 0.80. And if you look at the returns, 1 month return for this fund has been negative 14%. And for any other fund that we looked at, it was at least minus 25%. So given that, we think this will be a very good fund to invest in as well. This has been presented and prepared by me, Fireball, and Isthatrathi. We welcome any questions you may have. Please do comment and like the video. You can join us on Discord as well. Anything you want to add, Rathi?
Once again, this was not a sponsored video. We did our own independent research and we came to the conclusions we said so. And
Yes, it
yeah,
was just a coincidence
that's it.
that both our top picks were Axis funds. We didn't go with the preconceived notion of giving Axis the best fund. But thank you for watching, and do join us on Discord or YouTube if you like our content or if you want to have more discussions with us. Thank you.